I'm Ernie Humphrey, Educational Programs Leader for Performative, the largest online community for corporate finance, accounting, treasury, and related professionals. I'd like to welcome everyone to today's webinar, Why Sales Tax Matters More Than Ever in 2014, Legislative, Regulatory, and Compliance Exposures. Despite the potential consequences of noncompliance with dynamic sales tax-related laws and regulations, companies often still fail to give sales tax its due. Today we'll explore the current legislative and regulatory environments in the world of sales tax and learn how companies are leveraging technology to drive sales tax compliance with all relevant local, state, and federal requirements. I would like to thank Avalara, whose commitment to thought leadership helps us make this webinar possible and deliver at no cost. A quick note on today's agenda. First, we'll have a presentation from our featured speaker. Then I'll move to the interactive Q&A session where we will spend the remainder of our hour. We would like this to be an interactive experience for you. So if you have any questions at any time, please go to the questions area in your GoToWebinar control panel and send us your questions. We can't promise to get all of them in, but we'll do our best. And we'll follow up afterwards on any questions we did not get to today. A few logistical notes about the webinar. Links to today's presentation and video recording of the webinar will be sent out to all attendees in 24 hours of the event. Those who would like CPE credits will need to answer all polling questions during the event and should have pre-registered for CPE credit. For any questions on CPE credits, please send an email to cpe@performative.com. Those who qualify for CPE credits will receive a certificate within 24 to 48 hours of the event. Again, we encourage you to ask questions on today's topic via the questions box in your GoToWebinar control panel anytime during the webinar. Finally, we ask to take a short survey today regarding the webinar. We greatly appreciate your feedback regarding our event today, as we always strive to improve the ROI we offer our event attendees for their valuable time. A quick word about Performative. Performative is the largest online community resource for senior-level corporate finance, accounting, treasury, and related leaders. Performative connects corporate finance leaders to provide instant advice and insights on the tough financial and strategic challenges that they face every day. Let's get started by introducing today's featured speaker, Shane Radigan. Shane currently serves as a tax law and compliance expert at Avalara and has been a small business advisor on tax planning and success issues for 10 years. He is responsible for managing compliance processes, reporting, and tracking trends in the sales tax compliance environment. He is a subject matter expert on sales tax compliance for both internal and external shareholders. Shane is an LLM in taxation from the University of Washington School of Law, his Juris Doctorate from Syracuse University College of Law, and holds a BS in Accounting and Business Administration from the State University of New York at Plattsburgh. With that, it is my distinct pleasure to hand the floor over to Shane Radigan. Shane, the floor is now yours. Please take it away for us. Thank you very much.
Thanks, Ernie. I appreciate gracious introduction. Thank you all very much for attending. I appreciate you taking the time today. I'm going to talk about some items that are in the news for 2014, and some changes in specific format, but mostly like to guide those of you that are on the call towards the areas where we see changes happening, rather than simply list a bunch of regulation and statutory sites. We'll try to walk through some of these areas that we see as areas of concern, and mostly dealing with the calculation and the decision on where and when to collect. We'll wind it up a little bit by talking about automation and some of the ways that technology, and particularly cloud-based technology, are really opening all sorts of new ways to combat and to vanquish the sales tax challenge, right, that we all face. So anyways, I do work for Avalara. I appreciate them giving me the opportunity to talk with you all. I appreciate also Performative giving us this great platform to talk about what I enjoy, believe it or not, sales tax compliance. Ernie did a great job of mentioning my background. I'll also mention, without a small dose of irony, that my father was a sales tax auditor for the state of New York for his entire 25-year career with the state. And, judging by what I would have thought I might have been doing when I was 20 years old, it truly is ironic that I end up talking to you today about this very subject. So anyways, enough about me. So today we're going to talk about a good deal of our time, and you might have predicted this, that we're going to talk about nexus and the obligation to collect. This is an area of sales tax compliance which has, got a lot of attention even in the mainstream press, and news feeds are buzzing about, internet sales tax. We hear terms like this, and so I thought, it's really important to kind of get a handle on where we are. And really, there's two ways of looking at that. There's what's happening at the state level, and we'll look at a few items there, what have been colloquially termed Amazon laws. We'll also talk about U.S. congressional action, and that primarily is the proposed Marketplace Fairness Act. We'll talk about where that's at in Congress currently, and we'll talk about what's in it, at least in the proposed law. I'll wind it up, at least with the nuts and bolts type stuff that I'm going to talk about today, just generally talking about rates, taxability, which is our term to describe, what is taxable, what is not. We'll talk about some trends we see in those areas, and just a quick talk about boundaries, which I can almost tell you now is zip codes aren't good enough. That's the message, but we'll talk a little more about that. So anyways, let's get started. So Nexus, and I know I have a crew of people on this call that are sophisticated tax pros, but I want to make sure there's a baseline understanding of Nexus in the sales tax context, because it's so important when we talk about marketplace fairness. So Nexus is this legal connection that a company has with any given state that allows that state to obligate that vendor to collect on sales made within the state. So Nexus is, when we talk about the Quill case from 20 years ago, we talk about physical presence. Physical connections are a very important element of Nexus. So are other types of connections that may not be as intuitive as a brick and mortar store or warehouse. Some of what we'll mention today, and particularly in New York State and a few other states, you'll see that the states are putting people to work at getting creative in finding new pathways to establish Nexus. Nexus is that legal key, that legal test that gives the state the right or the ability to obligate a company from out of state to collect on sales. And Nexus is at the core of marketplace fairness. That second paragraph there, I'm sure, is very intuitive to all of you, but it's important to mention. This is not just a case where the states are, loping along and paying lawyers to figure out new ways to establish Nexus because they are constitutional law buffs. There's a real financial and fiscal element to this, and primarily what we're talking about is the burst and growth of e-commerce, of remote vendors making sales across state lines. We'll learn a little bit about Amazon laws here, and of course they're the greatest example of this model. They're right across the Puget Sound from me up here in the Northwest. Amazon just bought another block of the city of Seattle. So, we know all about Amazon up here. You can even get your groceries delivered by Amazon in Seattle, Amazon Fresh. So anyways, enough about our friends across the Sound, but, suffice to say they have become the poster child, for lack of a more elegant term, for this explosion in e-commerce. And the states have responded because these remote sales where vendors lack traditional indices of Nexus in these remote states, vendors are not collecting. They can't be obligated to collect based on constitutional principles, right? We won't get too deep into that, but really we're talking about kind of fairness and due process, and how far can a state go to obligate a company from outside its borders to collect on its behalf. That's the real nut of all this, and this is what Amazon, at least early on, challenged the states on, and that they didn't have physical locations and those sales they were making, they just weren't obligated to collect. Now we all know Amazon has changed its tack, and this presentation today isn't about Amazon, but I think it's important to understand where that term comes from and how it relates to e-commerce. So, this Amazon law really, as far as I can tell, was probably created by some writer for the Times-Union in Albany, New York around 2008. New York State was one of the first states, legislatures to seriously adopt, began in the Department of Taxation and Finance, but eventually in the legislature to seriously adopt a law aimed at e-commerce, and it was eventually referred to as a click-through nexus, and we'll learn a little bit about it. But understand that this Amazon law can take many forms. In New York, we'll talk about click-through nexus. In other states like Texas, we see expansion of rules surrounding affiliated companies. So states are finding nexus when a company within their borders is related, usually through shared ownership, with a company outside the state who is making sales. Those laws are generally considered Amazon laws. And even another variety, another family tree of these laws are these mandatory reporting laws, laws that require that vendors who are not collecting tax are thereby required to notify the customer on each and every sales invoice that they owe use tax. So those are three kind of strains of Amazon laws. They're very different in their style and their approach, but the policy behind all of them is the same, and that is to expand the class of businesses that a state can obligate to collect. Now, I know we've spent a lot of time talking about this, but it's important because as we talk about marketplace fairness in a few slides, you're going to see that that's really nexus is the concept that marketplace fairness is all about. Let's talk about that click-through nexus because it's fascinating and it's important for anyone who's in e-com or anyone who's watching this policy struggle take place, and that is the struggle between enforced collection on remote sales and basically the status quo. What New York did, as I alluded to earlier, in 2008 and then finally by law in 2009, New York instituted a regulatory change whereby a vendor who advertises on a website based in New York with a advertisement that allows a customer, a user of the website, to click and be sent to the vendor's shopping cart, to the vendor's sales. When a sale is completed in that manner in New York, if the website based in New York is collecting money from the company that's advertising on their site, they are now considered their actions are considered soliciting under this rule in New York, and that thereby triggers nexus for the remote company. So if I'm a company in Michigan and I sell specialized barbecue grill accessories and I advertise on a website in central New York that is a barbecue rib recipe specialist website, and I pay the person running that website a few $100 a month to put my ad on their site, and particularly if I give them $10 every time someone clicks on it and buys a set of custom barbecue tongs from me, I am obligated under the New York law to collect on the sales that I make in New York, even if I have never set foot in New York. I don't have salespeople. I don't have a warehouse. I don't have a store. I don't have any connections, traditional type nexus connections with New York. Under that fact pattern and based on the law now in New York, I am considered a New York vendor, and I must register and collect on my New York sales. Just to give you a quick background, of course, these things are challenged quickly by industry folks, generally industry organizations that are have the interest of e-commerce in mind. This law was challenged. The New York State Court of Appeals, which is actually the highest court in New York, validated the law. Just recently, in October, November of 2013, the United States Supreme Court refused to hear the case. So if you remember your Schoolhouse Rock, once a law has been found constitutional by a highest state court and the U.S. Supreme Court refuses to hear the case, it's good law. Now, remember, the New York State Court could only look at the law on its face. The law hasn't been put into action for a long enough time for there to be what the judges would call an analysis of its practical effect. So that doesn't mean the window is closed on the challenges to this law in New York, but it does mean for the time being that is the law. Naturally, what occurred was, and in the meantime, several states adopted very similar passages in their own regulations and law, not all cut and pasted, but similar concepts. North Carolina, Illinois, but what we see is that, just to give you guys a quick flavor of this, how it is kind of a moving target these days, Illinois passed a similar provision which was found unconstitutional by an Illinois appeals court. So we can see that, there's a lot of tugging and pulling here at the state level, as the states are really trying their hardest from a legal sense, a legal theory sense, to get as many folks collecting as possible. Now listen, this and just a couple quick slides here talking about another type of Amazon law, which relates less to Nexus but relates to forcing the policy that we talked about, right? And that policy is collection on remote sale. Colorado is the leader in this. There have been a few other states that have adopted similar strategies, and the bottom line is it's very, very intuitive, I think, and that is Colorado wants to obligate remote sellers not to collect the tax, but to notice the customers in Colorado making the purchases that they have a use tax obligation to the state. Sales and use tax are these mirror images of one another. On a sale that is otherwise taxable, of course, the pink elephant in the room, which we never talk about because use tax compliance is so minimal, and there's so few policymakers that really want to go after voters directly. But the use tax is an obligation on the consumer when they make a remote sale. And in Colorado is no different than any other sales tax state. What Colorado is demanding, though, is that vendors include a calc on the actual invoice with a piece of legalese, that is going to tell everybody you are obligated to collect. Boilerplate. Thank you to the lawyers on the call. I could hear you getting it to me. Some boilerplate language on there, letting people know that, yeah, you owe this. Your vendor didn't collect it because they're in Virginia and we can't force them to collect it. But what we really want you to know is we want you to stay up at night thinking about this use tax that you owe. There's also an element of it in Colorado that requires the vendors to report to the state of Colorado the sales that are made into the state where tax was not collected. So there's some real teeth in this law. The quick history on it, it was overturned or found to be unconstitutional by a lower Colorado court, a Colorado appeals court. Throughout the injunction from the lower court, which had prevented the enforcement of the rules, but did so in a way that doesn't really solve the legal problem. What that appeals court said is, hey, this is a federal issue. This is not a state issue. So time will tell. And based on that, Colorado has, and you guys can kind of read this, but basically Colorado said, hey, we know that Direct Marketing Association is pursuing this in federal court. We know that at least one court in Colorado didn't like it. So we are not enforcing, at least as of January 31, up to deadline, to report 2013 sales. So there won't, at least no penalties for failure to comply. So take that for whatever it's worth, but right now that's up in the air. There's a few other states that did similar changes, and I don't know the particular current status of those, other than I can tell you that I don't know of any state where this is now the law. Except for Colorado, except we have this notice from the state DOR in Colorado stating that they're not going to be assessing penalties. So, time will tell. But keep in mind that this is an Amazon law. This is the policy behind this law is no different from New York's click-through law, and that is to obligate more and more vendors to collect that are making sales into Colorado but lack traditional physical locations in the state. Okay, so let's switch over to congressional action, because that's why I've done this whole lead-up on Nexus, because it's important, because marketplace fairness is about Nexus. The proposed Marketplace Fairness Act is a law which enforces reporting or collecting and remitting obligation on vendors from outside of any given state. Marketplace fairness is, you might consider like a permission slip for the states. And once a company qualifies under the provisions of the act, the proposed act, which I'll run down here, that company is obligated to register and collect in all sales tax states. And there is no more nexus analysis for that customer, at least not at that very moment. And that customer is now, or that vendor, excuse me guys, that vendor now has an obligation to collect in all states under the proposed act. The act does limit the sales that are subject to its provisions. It needs to be a remote sale. It's a sale that's made across state lines where no tax is collected. Currently, there's a $1 million threshold. The $1 million is an annual threshold. It refers to those remote sales, those sales that your company's making across state lines. Once you reach $1 million within a year, according to the proposed law, you are now subject to the law. And that can be in any state or any combination of states or any mathematical analysis you can think of to come up with $1 million. It can be $20,000 in 50 states or $1 million in one state. It doesn't matter, at least in the language of the current proposed act. And like I mentioned earlier, or just a few moments ago, once your company is under the gun, so to speak, is now qualified under Marketplace Fairness Act, any state who has done the minor obligations, completed the minor obligations that they're required to, you're required to collect them. So for all practical purposes, I don't see a situation where any state is going to avoid taking advantage of this law. So forgive me if I start to sound like it's kind of a done deal in every state. Technically, it's not. But for all practical purposes, it's hard to see a situation where the states would not take advantage of this law. So that's what the law will do. Under a federal law, because this is a Commerce Clause issue, all the Supreme Court cases on sales taxes, not very many of them, but over the years, have all mentioned, at least to one degree or another, that this is an area where Congress has constitutional authority to act. There's really no question. So whether or not there would be challenges to this law on a constitutional basis, yes, there probably would be. But based on this amateur constitutional law lawyer's analysis, they're probably not going to be very successful. I think Congress can really speak in this area if they choose to, and that's what this law is doing, proposed law. And it would enforce or would allow any state to obligate any vendor anywhere who is making $1 million a year in remote sales. So, that means universal collection. It also means something that already exists to a degree, but I always find is important to mention. This is a destination-based obligation. And that probably is intuitive to a lot of you that have had experience in sales tax, but for those of you that haven't had a lot of experience in sales tax, it's important to keep that in mind. These calculations are destination-based. That means the rules and the rates and the remittance that is required is based on the location of your customer, the destination of the goods that you sell, the objects that you're selling, I should say, because we're sometimes talking about digital goods, and software across the cloud. But, appreciate that the objects that you sell are based, the rules and the taxability surrounding those sales is based on the customer's location. That's a basic tenet of marketplace fairness. It's frankly a basic tenet of the current sales tax universe we live in. But I think it's important to mention that for those of you that don't have a lot of sales tax background. I mentioned a few moments ago the states under the proposed Marketplace Fairness Act do have some obligations before they can fully take advantage of the act. The obligations are not extreme, but they do require that the state make a good effort to publicize all rates, publicize taxability matrices, not unlike the SST requires now. We'll talk a little bit about SST today. And most importantly, for a few states, the Marketplace Fairness Act would really probably ring the end of true home rule calculations. There's 4 states in the U.S., Colorado, Arizona, Alabama, and Louisiana, that currently allow, constitutionally within their state, allow localities to not only set their own rates, but to set their own sales tax regime. So forms can vary amongst localities in those states. What is taxable and what is not can vary. Those elements, those home rule elements, again, this is just my very inexperienced constitutional lawyer speaking out here, but I think I'm right. I don't see how those home rules are going to exist if those states want to take advantage of marketplace fairness. So the word is simplicity, and if we can eliminate the layers of complexity associated, at least in those 4 states, with home rule capacity, then the marketplace fairness has brought some simplicity to the sales tax universe. I think it's important to mention what the Marketplace Fairness Act doesn't do. Marketplace fairness does not determine what is taxable and what is not. It doesn't determine whether or not, or what rate a state wants to exert on a given sale. Doesn't enforce any particular uniformity or harmony when it comes to defining goods. It encourages it. It encourages it through endorsement of the SST, but it doesn't mean that sales tax rules are going to become, at least under its own language, more and more exact or harmonious from jurisdiction to jurisdiction. Yeah, I think that's probably the end of what I want to mention about marketplace fairness. I'm open to taking questions on it. There are a lot of times many detailed questions about the provisions of it, and I'm glad to answer them, but it is a proposed act. What I do want to mention, and this is, I don't include a slide. You see me checking there, but I don't have a slide for this because it's a moving target. Just so you know where the law is at. The law was actually passed by the Senate in 2013. It never made it out of committee in the House. However, the House committee chairman, I believe it's in the Judiciary Committee and maybe a subcommittee of that, the chairman of the committee that got the bill is a guy named Goodlatte. Forgive me, I forget where he's from, but he is not necessarily a big cheerleader for marketplace fairness historically. But what he did at the end of last year was issue some principles that he would, if a law was in front of him that was aimed at requiring a collection on sales tax or remote sales, as long as the law met these principles, he'd be open to it. And I won't get too deep into those principles, but yeah, I think they're not as far off as we might have thought prior to him releasing that. So what we do know is that there's going to be some congressional hearings by this committee on state and local tax issues in February. We don't even know if that means that they're going to be talking about marketplace fairness or not. The description is very general and very broad, so time will tell. Now, I mentioned rates earlier, so we're shifting gears a little bit now. We're no longer talking about nexus, and we're no longer talking about marketplace fairness. What we're talking about now is more like things to look out for and changes and areas that are a concern for anyone who is in charge of sales tax compliance, right? So let's talk about rates. And again, I apologize for those of you that have been living the sales tax world for years. Some of this will be really intuitive to you, but for those of you that are not necessarily sales tax experts, I think it's important to talk about these elements of a calculation and where and how they change and how they can affect the transactions that your company or your clients are asking you for help understanding the sales tax implications. So with rates, rates are exactly what I mean. What's the percentage of rate that's applied to a given sale? There's hundreds and maybe thousands of unique rates in the U.S. And there's variability for a couple reasons. One of them is localities. Any of you that, and I'm sure that's a majority of you that live in a state that has a sales tax, can appreciate, for most of you anyways, that rates can vary from location to location. There's those 4 home rule states I mentioned, Colorado, Arizona, Louisiana, and Alabama, that actually give their localities the ability to collect their own sales taxes, but there's also a majority of states that are, even though the state taxes, the sales taxes are administered only at a state level, they do allow locals to vary their rates. So this, a great deal of this variability comes from the fact that in most states, local governments and local level tax authorities are able to set their own rates. There's a dozen or so states out there that do not allow their locals to set their own rates, and rates are similar across the state line, across the entire state. However, that introduces the other element of variability with rates, which so we're not talking just about as rates vary from town to town and county to county and stadium district to transit improvement district to library district, but what we're also talking about are different rate charts for different types of products, different types of transactions. So many states employ different rates for food, prepared or not, restaurant, grocery. The rates can vary depending on how food is purchased. Medical supplies, not just bandages, but not just dialysis machines, everything in between. And the states can not only apply unique rates to certain objects, but there's not a lot of uniformity from state to state when it comes to actually defining those objects. So I'll talk a little bit about taxability before we're done here, but suffice to say there's a lot of complexity in these areas of specialized products or services. You see some services subject to special rates, data processing and computer services in Texas, which happens to also include SaaS, based on some obscure private letter rulings here and there, is subject to not a different rate, but a different tax base. So from the customer's point of view, it just looks like a reduced rate, but the actual calculation is a reduction in the base. So if I am selling SaaS to a customer in Texas or data processing services, and I bill them $100, I charge them sales tax at the regular rate based on the county, city, local jurisdiction that they exist in, but I only charge it on $80 because the rule forces me to adjust the base of the item that's being taxed. So, what sometimes is perceived as a difference in rate is actually an alteration of the tax base based on state law. Massachusetts does it, a few others. This is just a quickie, and this is kind of my substitution for not running down rule after rule after rule to you guys and putting you all to sleep today. What we do is I just do a quick sample of things that are changing, and this is just to give you a taste of the types of changes that are out there. And remember, most states are on a June to July or July to June fiscal year, so January 1st is actually not necessarily a time when there's a lot of a great rush of changes. There may be more than usual, but just appreciate that. This happens all the time. Illinois, Arkansas, Texas, you can see there's over 10 or 12 states listed there. Also, we talked about not only localities and their changing rates, we talked about different tax rates on different products in North Carolina, just as something to keep in mind more as an example of how fluid this can be. North Carolina no longer applies a reduced rate to sales of mobile homes, which for some folks that's a huge purchase. So now a mobile home purchase in North Carolina is taxed at the regular rate, whatever that rate is, as it applies to that particular location. Also, new products are introduced and new products are made legal. So in Colorado, marijuana now is a regular retail product. Colorado has a special tax rate on marijuana, 10%. It's a unique rate. We'll talk real quickly about taxability. This nuts and bolts stuff is really probably a reminder for most of you. Taxability is a little bit what we've been mentioning already about how states can vary on what they tax and what they don't. We mentioned SST, the Streamlined Sales Tax Initiative. That is a voluntary organization of states that does its charter and principle. One of its most important founding principles is to harmonize sales tax definitions and descriptions across state lines. It is not the SST's intention or accomplishment to enforce uniform taxability, however. So among SST states, I have myself as a researcher, I see lots of progress in, and what I'm really getting at, folks, is, you know, a pink widget in one SST state is defined with exactly the same language as a pink widget in another SST state. So we are seeing some uniformity there, but just keep in mind, SST still doesn't have a say in whether state A wants to tax pink widgets and state B wants to not tax pink widgets. SST doesn't have a say on what rates apply. So, you know, keep in mind it's a wonderful initiative, and as more and more states are joining, there is 23 member states now, 21 full members, a couple associate members, so we're up to half of the sales tax states now are part of SST, and that evolution continues, and it is helpful, and it is helping to simplify at least how we all understand the products and services that we sell. Keep in mind that taxability relates to not just what you sell, but who you are and who your customers are, right? Hospitals and not-for-profits, and whether or not, you know, you're a exempt reseller. You know, these are all areas that affect taxability that are not related to the objects you're selling, but are related to the entity that you might be or the entity that your customer is. As far as what we see on the horizon, no question, services targeted more and more. Services are, you know, an area of the economy that's growing. Clearly, people are spending less money on things and more money on services, and the revenue authorities are not blind to this. So it's not a revolutionary movement. It's certainly evolutionary, but clearly there's only one direction that this is going, and that is that more and more states are being more and more aggressive when it comes to taxing services. Related to that is software and cloud services and digital goods. We've thrown them all in there together because this is not a terribly technical discussion today, but suffice to say that for the same reasons that services are on the minds of revenue collectors, so are these products. People are spending more and more of their money on software and digital objects, and they're receiving them without the aid of physical media, right? And that's really what has altered the game for many states, is the ability of folks to make purchases of retail purchases of items that just utterly lack any physicality besides a stream of electrons moving across phone lines or glass lines, right? So important to keep that concept in mind whenever somebody walks in your office and says, hey, what do you think about this thing we're selling now? If it's one of those things, or it's a service, or it's related to a service in any way, you can't rely on what was going on even just a few years ago in many cases. Here's a good example in North Carolina. Just breeze through this quickly, but it's a great example. North Carolina now taxes all software service contracts. Before January 1st, North Carolina would only tax a software service contract if it was mandatory to the customer. But now even a customer that purchases a software maintenance contract or a service contract, again, the states vary a little bit on these definitions, but I think we all have a pretty good understanding of what we're talking about here. Optional or not, they're taxable in North Carolina. And this is a great example of services and technology both being both in the crosshairs of the state revenue authorities, you know, and there's certainly policy behind it, but you can appreciate that these types of services, especially related to anything technical, are under a lot of pressure now, state by state, and you know, this is just one great example. Just as a note, everyone on the call, keep in mind that the changes that are made in North Carolina also apply to other types of service contracts. I thought the connection to the software was an important one to make. Massachusetts had an example of the opposite. In this year in July, they instituted changes which made some computer services taxable. The description that they had for taxable services, computer services, was actually quite limited, but there was pretty good public kind of, I don't know if outrage is the right word, but more than a few journalists picked up on it. I actually read in a few places that it indicated Massachusetts is becoming unfriendly to technology. It really was not a major glacial change. It really was just a tiny iceberg of a change. People perceived that it was much broader, and what happened was that it was repealed. So they made changes, and the changes were enforceable for about 6 weeks, and then they repealed them. And from a compliance point of view, it's just terrible. It's horrible for folks in this area trying to adapt to new changes, in this case computer services, and then the state kind of pulled the rug out on them. But to the broader point, this is how this is happening. The states are really picking up on services, and especially anything related to technology, and they're trying to collect as much tax as they can on these services as quickly as possible. Here's some quick changes, again, kind of like my rate change, just a sample, but it gives you an idea. Colorado, all Denver area special taxing jurisdictions now use exactly the state rules when it comes to taxability of things. This is a good thing. This means that some of those home rule jurisdictions in Colorado now have kind of thrown up their hands and said, no, we're just going to use the Colorado rules. This is a good thing, right? Rhode Island eliminate their sales tax on art and artistic creations. At the same time, North Carolina instituted a sales tax on art and artistic creations, including admissions to galleries and things like that. Maybe not that critical for folks on this call today, but it gives you an idea of the fluidity that we're dealing with and how the states can be going in different directions. The next one is Florida, which is actually probably really important to some of you. Manufacturing products will be exempt from sales tax for 3 years, starting April 30th, 2014. So you can also see that sales tax changes can impact other financial issues or other financial areas for a company, such as purchasing and budgeting. Manufacturing equipment is not inexpensive, so this exemption can really mean something for certain customers. Note the Internet Tax Freedom Act sunsets in November 2014. This is this congressional law that really is what keeps your cable company from charging you for Internet access in terms of maybe not even your cable company, but maybe Google. There's also provisions in there that talk about transactions made over the Internet. Occasionally this law is used as a shield against nexus laws that we talked about earlier, like Amazon laws. Hard to tell what will happen here. Probably most likely it'll become permanent law, but there's always the possibility that our Congress, such as it is, will not be able to come to an agreement, and that law may disappear, which would only give the states just an incremental more leash, so to speak, to continue to expand their nexus concept, right? Boundaries, just really quick, you guys. There's special taxing jurisdictions all over the country. There's almost 12,000 separate jurisdictions in the U.S. now. The jurisdictions can change. The theme today is change. Annexation, changes in zoning. A collection authority can change for a given special taxing jurisdiction, particularly in a home rule state. Real quickly, rooftop accuracy. I think I got to that when we talked about our polling question. Zip codes are just not reliable when it comes to locating your customer and the exact tax that is due. And this is when it's with these STJs particularly when it gets very hairy. We've seen some maps drawn in Colorado, for example, where an STJ goes on one side of the street, crosses the street, crosses back, so it can be real variable, and zip codes just aren't really even close. International issues, I always add this on here. Keep it in mind if you guys are dealing with your own team or a client who wants to do business overseas, particularly somebody that's dealing on the internet. They're not going to be in a sales tax world outside of the U.S. They're going to be in a VAT world. Value-added tax is a very different universe from sales tax, and it is somewhat counterintuitive. In fact, it's very counterintuitive at times. And this is really just a reminder to my friends, my professional colleagues out there that once you step outside the U.S., almost invariably you're dealing with a VAT regime, and you really need to throw out what you have learned about sales tax when it comes to that. Now, when it comes to how to deal with all this, and probably everyone on this call is nodding their heads in agreement at that first bullet point. Manual compliance, for many of the reasons I talked about today, and the complexity of filing and remitting in general, the Treasury function as well, prone to errors. And this is an area where we still have jurisdictions in some places that I won't name that will require a paper form. Their form is available online in a non-fillable PDF format. So, when it comes to sales tax compliance, we really see the gamut run when it comes to ability to automate even the most basic filing functions, even from when you're doing it manually, right? Some jurisdictions are truly manual. Get out your pencil, print the form, and fill it out. Automating and outsourcing, I think these bullet points here, I think, relate to much more than just sales tax. But sales tax is a great example for how automation, outsourcing can help, because it is a complex area of law, and it's a very fluid area of law, which is why a cloud-based solution, and again, for the reasons that we all know cloud-based solutions are the best, is so advantageous because, here we go. Here's our next slide. I beat myself to it. It's an ever-changing landscape, and that really goes without saying. It's the world I live in. It's fun and dynamic to be someone that's a professional in this area, but when you are charged with compliance for a particular outfit and things don't go right, you can really find yourself in the hot seat. So, I don't know if doing it manually will fail with an underline there, but my experience is that eventually there'll be headaches. That comes from my experience of not only living with Dad for 25 years, but also being a business owner myself. My exemption certificate management system was the third file drawer in the dusty file in the back corner of the break room, right? So, I understand where these systems can fail. Automation is where it's at. This happens to be a product breakdown based on Avalara products, but you'll see amongst the other folks that are out there, and believe me, there's several very worthy sales tax automation platforms. They're all kind of broken down this way. The calculation, that's really what I've talked about today. Getting the right address, getting the right rate, figuring out what you sell is taxable. Do I need to collect in this place? That's your calculation. That's that left column. Center column is exemption certificate management. And again, you'll see not just Avalara, but anyone in this game has got an automated exemption certificate management. And that relates exactly to what I was talking about with my old motorcycle shop. If you're selling the folks exempt based on certificates, particularly if you've got a bunch of resellers or a bunch of not-for-profits or whatever, you've got a real obligation to manage those certificates. If you're selling to an organization and exempting sales to them based on a certificate that is not valid, you are on the hook. For your company is on the hook for the taxes and T&I. So this is a true obligation of a vendor. And then, of course, the third column is return. And this is when I mentioned the paper return. Of course, this is what I'm alluding to. Automating returns is exactly what it sounds like. It's putting the technology to work for your company. So you're just, as you expand and grow and need to have a more robust sales tax compliance function, you don't just need to keep adding heads. You got to find a way to accomplish the exponential requirements without adding bodies, for most of you anyways. Help and because these changes are not regular and they're obscure at times. So anyhow, keep in mind how important that this can be for you. Best practices. This is just wonderful stuff here. Nexus, rate boundary changes. Report and state you need to. Know your filing requirements. Are you monthly, quarterly, annually? Make sure that if you're using zip codes, you're thinking about some way of improving. through some sort of mapping process. Taxability is all over the map. And finally, certificate management is, I think, sometimes the last thing we all think about, but it's really important, especially if you're making a lot of sales based on exemption certificates. So there's our takeaways. Those are the pieces that we talked about today: Nexus and the proposed federal legislation, rates and taxability and boundaries. I hope I got the message across that there's a lot of variability out there, and then of course I hope I got it across about Nexus. It's a very important area for all of you. So I appreciate your time today very much. I'm so sorry that I sucked up the Q&A time, but we will get replies back to anyone who sent in a question. So Ernie, I'll turn it over to you.
And finally, I would like to give a big thanks to our audience today for their valuable time. We hope to see you again soon at another Performative event or online at www.performative.com. Make the rest of your day great, everyone. Thank you very much.
Thank you for attending, folks.